Welcome back to our Financial Mastery series. Today, we're delving deep into a strategy called debt recycling and how Australians can utilize it to save tax and accelerate their home mortgage repayments. Let's get started. Imagine owning a house. Over time, as you pay down your mortgage, you're building up equity. Now, what if you could use that equity to create more wealth and pay off your mortgage faster? Enter into debt recycling. In its simplest form, debt recycling is about turning non-deductible debt, like your home mortgage, into deductible debt associated with an income-producing investment. On a primary home, debt recycling typically involves using its built-up equity as collateral to borrow funds for income-producing investments, thereby converting non-deductible mortgage debt into deductible investment debt. So why does this matter in Australia? Well, interest on loans used for investments is tax-deductible. By using your home equity to buy an investment property, you can offset your taxable income. But how exactly does this work? Equity release: you refinance or draw on the equity of your primary home. Equity release allows homeowners to access the built-up value in their property by refinancing or drawing funds from their home's equity, providing capital for other ventures or needs. In Australia, the tax treatment of interest on borrowed funds depends on the purpose of the loan, not the source of the security like your primary home. For example, if you borrow against the equity in your primary home through a refinance or a line of credit and use those funds for an income-producing purpose, such as buying an investment property or shares, the interest on that portion of the loan can be tax-deductible. You invest these funds into income-producing assets, like an investment property. Investing in property can be a pathway to building long-term wealth. By investing these released funds into assets like properties, you create avenues for consistent income and potential long-term wealth growth. The interest on this investment loan is tax-deductible, and any returns from the investment can be used to pay down your non-deductible primary home mortgage faster. A tax deduction reduces the amount of income that is subject to taxation. However, if you use the borrowed funds for personal use, like buying a car or going on a holiday, the interest is not tax-deductible, even if the funds were borrowed against your primary home's equity. Now, you might be wondering, what are the best investment solutions? 1. Investment properties. Investment properties are real estate assets purchased with the intention of earning returns through rental income or capital appreciation, and one of the most popular methods in Australia. 2. Shares. Shares represent ownership in a company and can yield dividends or appreciate in value. They offer both dividends and potential capital growth. 3. Managed funds. Managed funds pool together money from multiple investors to diversify and manage investments on their behalf. The returns from these investments, whether it's rent from a property, dividends from shares, or distributions from managed funds, can be used to pay off your primary home mortgage. And the beauty of it? Since the interest on your investment loan is tax-deductible, you're effectively reducing your taxable income, allowing you to save on taxes while you work to own your home outright. In Australia, the return on investment itself is not tax-deductible. Instead, the expenses incurred to generate that income, such as interest on an investment loan, can be tax-deductible. Let's clarify this a bit. Interest expenses: if you've taken out a loan to invest in an income-producing asset, such as a rental property or shares, the interest on that loan can be tax-deductible against the income produced by that investment. Capital gains tax or CGT: when you sell an investment asset for a profit, you may have to pay capital gains tax on the profit, or capital gain. If you're an individual or a trust and you've held the asset for more than 12 months, you may be entitled to a 50% discount on the capital gain, which means you'd only include half of the capital gain in your assessable income. However, you're allowed to deduct certain expenses related to the purchase and sale of the asset from the capital gain, which reduces the taxable amount. Rental property expenses: if you have a rental property, certain expenses can be deducted against the rental income. These expenses include but are not limited to interest on the property loan, property management fees, maintenance, and repairs. Dividend income: dividends received from shares might come with franking credits if the company has already paid tax on its profits. These franking credits can be used to offset your personal income tax. Deductions on shares: if you've invested in shares, you can't deduct the return or dividends but can deduct related expenses, like fees for investment advice or the interest on a margin loan. It's important to differentiate between the actual return on investment and the expenses associated with generating that return. The return, like rental income or dividends, is usually considered taxable income, while certain associated expenses are tax-deductible. However, like any financial strategy, there are risks involved. Always consult a financial advisor or a tax advisor or an accountant to see if debt recycling is right for your circumstances and to understand the specifics of your situation and how Australian tax law applies to you. So, debt recycling is a strategy to potentially build wealth, save on taxes, and pay off your mortgage faster. If you found this helpful, please like, share, and subscribe for more financial insights.